See if the channel is streaming yet. See how much of a delay there is. Testing 1 2 3 1 2 3. Okay, cool. I think I got decent volume. One, two, three, 1 2 3. Seems good enough to me, man. This is the first ever QQQ After the Bell episode 1. This is the recap of QQQ Before the Bell. This is on Beta Heuristics Substack here. Move my head so you can see Beta Heuristics again, the channel. Make sure you comment, like, subscribe on all platforms. It helps with all the algorithms. I am your host, Chris McVitie, and I will do my best to keep this in short form content so that when it's clipped, it's just perfect. So the entire point of the QQQ Before the Bell is to provide anyone interested in investing or trading the NASDAQ. I think the NASDAQ is a long-term good investment, maybe not buying it near all-time highs, but relative to just investing by saving dollars as passive income, technology has outperformed long-term. But trading the volatility of the NASDAQ, this is a report that is intended to just, it's intended to assist anyone interested in trading the NASDAQ in being prepared, in understanding what are the probabilities of price breaking higher or lower based on how it's trading relative to its prior intraday range. That is the whole thesis. There's no need to sugarcoat it. I'm not going to pretend to hide the alpha here. I will just say it right outright. I want to real quickly, before I dive into this, I want to do some testing and just see if it looks better if I so this shouldn't take me too long to do. If I wanted to, I wonder if me messing with a camera is not a good idea. How does the green screen just look? Does that look better than, you can't really see. Oh shit. All right, well, Control Z doesn't make the filter go back, so there you go. I can't get it to be that clear though. Let me try one more time with this. Now, I don't think it's contrast or brightness. Maybe smoothness would make it look better. I can't tell if it's getting more, I'm getting more grainy. Shit. I think I've gotten worse. I think I messed it up. I just can't tell if like my face is grainy and the whole camera needs to be focused better. Camera. Focus. Focus. Lock in, chat. We're doing it. This is the QQQ After the Bell. This is the recap of the first ever episode 1 of QQQ Before the Bell. Markets don't reward predictions, they reward preparation and well-timed execution. Today's levels were provided based on the prior intraday range, Friday, March 20th. And Friday, the momentum was taking price lower. And overall, today's key level was 582. When I show the Thinkorswim platform, you'll see how the pre-market kind of invalidated that level. The pre-market here, the entire point of showing this is to just, I can't really zoom in at all. So it'll be impossible to get this actually fit for the, trying to get everything situated perfectly for vertical format is a little difficult at times, but we're learning, chat. We got this. I wanted to see if I can zoom in a little better. So basically, we've been holding in a consolidation of barely lower lows, definitely holding lower highs. And Friday, we closed at a year-to-date low. Year-to-date, the NASDAQ was closing near a year-to-date low relative to its yearly open. Yearly open, 620 for the NASDAQ, and we had closed 582. So Friday, we were leaning more bearish based on this continuation to the downside. That doesn't mean we are going to have massive follow through, but understanding that there was this momentum continuing to start the weekend, that momentum will either A, have the continuation, or B, be a trap where the buyers who held their, the sellers who held their positions through the weekend expecting prices to continue lower, these sellers that are selling high trying to buy it back low are forced to quickly buy it back, especially when President Trump has tweets about the war in Iran that are then proven untrue. So price today peaked, year to date, price had peaked at 636.60 cents. This was back in late January, of course. And we've been in this slow descending triangle, lower high, lower low consolidation, provided some key levels prior close, the range where we might see bull extension, the points of support. The intraday, I'll show this actually on the Thinkorswim platform in a moment. The different scenarios provided, basically you're a bull on a reclaim above 582, holding higher low structure relative to that and looking to climb higher. The bear scenario was acceptance below 785.5 and looking for the continuation to 571 on the downside. The consolidation scenario, which is, I believe, a blend of consolidation and bull scenarios, what is the most accurate representation of how price traded today. And the consolidation scenario was that neither side fully commits and price is compressing within Friday's range, essentially. We did break out of Friday's range and then break back in it. Provided volatility based on the Wall Street betting on range. I wanted to put my hat in the ring betting on a range of $8 to $10 based on implied volatility range calculations, understanding past range performance relative to the estimations and understanding that the expected range, $5, and expansion of that range if we get more volatile, looking for $8 to $10 range on the NASDAQ. Let's see how that performed shortly. And the summary just more condensed for people that want it as simple, sweet as possible. And the ending note, just want to reiterate that the Substack currently free. At some point, I believe after end of April, I believe, I'll shift it to being a paid membership where $5, $10 a month, you will get the daily uploads before the bell, and I will have these post-market after the bell recaps as often as I can. having to have at least a 30 to 60-minute recap. There will be background noise. I have upstairs neighbors. It is what it is. And there's also a note that was written. The note is simply just to highlight that midday we were in the bull scenario and that we had opened 590 and a half. We'd gapped above that 582 pivot point, and we had been basically trying to break higher on that geopolitical event where there's de-escalation. Let me get in frame. De-escalation of the Strait of Hormuz tensions between Iran and United States and Israel. So it reduced, we were already headed to test upside. When you have very volatile sell days, you can often bounce and have a retracement of 50% of that range. That's a natural mechanism within equity markets. You throw a President Trump tweet on top of it, it's already a lit fire. You throw gasoline on it, of course, it's going to accelerate the ongoing move. So instead of having 582 be this pivot point, instead of the midpoint of Friday even being an important point, we'll see that we just broke through everything today on the NASDAQ. The whole point of me giving this midday update was trying to reiterate that, and I rushed it out so I didn't get enough of my key point, but I was trying to highlight that the simple bull scenario, bear scenario, consolidation scenario, it's an oversimplification because you can have half of the day be in a bull scenario where today on the NASDAQ, I forgot to get this to the right size, formatted for the screen now. Come on, work with me here. Work with me, baby. Don't do that to me. Why can't I grab you? Thank you. I just needed it. Thank you. Jeez. I can't. Okay. So the whole point is that instead of engaging anywhere with this is here Friday, the range of you had a gap down that could not fill up and you had continued selling. And now here, what have we done? You've had a move, a gap up of 1.4%. The 582 area, I'm not in frame, I guess, my mistake. Take two. From Friday's close here, Friday's close to the open here, this is showing you a gap up of 1.4%. This gap up is not having massive continuation. The market peaked on the NASDAQ up 2.2%. And this is a very common occurrence where the market has a high of day and then loops and tags and holds that high. It fails to make a new high of day. The structure does not continue to consolidate and break higher. Instead, this is a loop and tag reject before you have a retest of the lows here. But the retest, sometimes it's the steps up and then the elevator down, where the people that have been long this market, they were long on Friday before the close, they were long the market in the pre-market, they were anticipating retests of Friday's high. Maybe they didn't anticipate Trump's tweet, but they take the gift, closing gains before you have the larger sell move. You want to be, if you're thinking like the institution, you're selling near the highs, and on the failure here to make new highs, that was the signal that price was going to continue lower. And the continuation lower, finding support at the golden zone, the top of the golden zone. This is the 61.8 of Friday's intraday range. And here you see that you test below it, go right back above it, and it's a loop and tag. You're at this key area, you're testing just below it, snapping above, looping, holding here before you can then break upside. The loop tag confirmation is the clear reaction of price action, and here, after you fail to make the highs, the sell move, loops and tag holds before you can bounce. And the movement here, really, you're just stuck beneath Friday's high. You're consolidating beneath it, unable to break higher into 1500, 3 p.m. power hour, the last hour of the market. The lower high here versus the high of day that had already rejected, the sellers continued for the final. If you could only be trading that final hour, how much range was there? From the open of the hourly candle to the low, that is 0.47% move. That is $2.79 on the NASDAQ. You can see really the acceleration to the downside after after the final 9 to 10 minutes, 3:50 p.m. last time of day for algorithms to get their order flow out there, and there's an influx of order flow and volatility. So it's a natural ebb and flow of the market, and understanding where yesterday's range is relative to today's opening range, understanding that you don't have overbought, oversold, you have exhaustion. You have a gap up. Most retail traders, they live by fallacies. They think, oh, a gap up, now the gap is going to fill. The gap may fill, that's a probability. Assuming that within the first 5-10 minutes that it will fill because you see wicking, you see some sell pressure, you see that wicking sell pressure, you think the gap will fill lower. It's a fallacy based on a bias, and understanding that the volatility, before you will sell, you will more likely go higher. The market makers, the institutional traders, they want to buy low, sell high. They've already been buying. They're adding here on the consolidation. They're covering on the loop tag confirmation, and they're riding the wave lower with short hedges. This is how you manage risk via the NASDAQ, because it just provides this constant volatility. Even the fact that you gap up overnight 1.4%, some retail traders, they don't feel comfortable taking swing trades, overnight trades. Even then, the range here is 1.5%. Intraday range, 1.5%. It's a $9 move. Intraday range. The discussion back here talking about the volatility, if I'm not mistaken. Yeah, 8 to 10 was the expanded range. We had already really gapped up overnight up 2.2%. We end up 1% because you retrace back down. There's this constant ebb and flow within the financial markets, and when you are present and patient, focused more on the higher time frames than the lower time frames, the 1 minute is overrated. You get lost in the little details of every little candlestick. You're stuck looking at one tree, lost in the broader forest. Or I just wanted to get this QQQ after the bell episode 1 breakdown, because it's not as simple as the bull scenario was adhered to. That's an oversimplification. It's an oversimplification to think that one straightforward scenario is sufficient in explaining how the equity market, specifically the NASDAQ, how it will ebb and flow. It will provide constant volatility and opportunity to the traders that are present to trade it. And to those that aren't, it might not be the best investment opportunity. I'm not a registered financial advisor. I won't pretend to give financial advice for a living. When we look at the NASDAQ on a 10-year weekly, let's actually go all the way out to a month, go max available. So the monthly chart of this from, you can't see it as well, but the low was down here. So back in 2000, or I should say 1999, launching of the QQQ ETF, retracement down, consolidation before it starts to make its move higher. And now you can see, you know, understanding the larger context instead of just the 5-10 minute price action compared to how it was yesterday. When we stop and really pay attention to the higher time frames, I want to be very careful with my words here. When I stop and acknowledge where price is, I don't want to be a long-term investor in the NASDAQ. I don't. The blue light reflection off my glasses was bothering me. I can do without them for a few minutes. When we see the NASDAQ has, if you take the 2020 low from the pandemic up to the high of, at one point, this was an all-time high back in 2021. Feels like forever ago. You've broken above that Fibonacci extension. That is a calculated area from algorithms. I can feel my voice going. The entire range, if you take, it's not valuable to take the all-time low because the market, the participants in it, the investors, the traders, the high-frequency algorithms, it is a completely different game post 2005, 2008, 2010. The last 20 years has been a completely different market than the, you know, you would maybe say this more so with the Dow or the SPY, the S&P 500 that have existed longer, that have more history. It's not even worth going back and looking at that stuff just because it's not that market anymore. So if you just take the 2020 low from the pandemic and you go to the all-time high, we have so much range to retrace. It's not even funny. If you really saw what would a real bear market look like? Instead of a month, let's look at a yearly. So yearly chart here. The yearly open down 20%. Is 494.18 cents. 494, 495, that area is where the NASDAQ is down 20%. You are retracing, wow, you would be basically coming back down below that close. It would take an immense amount of volatility and sell pressure to actually be able to break this market into a bear market, the NASDAQ specifically. For the NASDAQ to enter a bear market, it would require a large amount of sell-side volatility. The only Chicken Little, the sky is falling, worst case scenario is the Gulf states that have invested hundreds of billions, possibly trillions, into the US stock market and debt market. If the Gulf nations, Kuwait, Qatar, the UAE, I'm forgetting Bahrain, if these Gulf nations want to, Saudi Arabia, I mean, come on. If these nations want to withdraw their money, I don't see how the money managers, whether it's Fidelity, or whether it's BlackRock, whether it's Citadel, or anyone in between, JP Morgan, it would be a nightmare. So that's the real black swan event, is that the escalating tensions in the Strait of Hormuz further damages the gasoline, or I should just say the petroleum refineries, the energy facilities, and the water desalinization. Water desalinization and the energy facilities, if these things are struck by Iran or just by happenstance, if any of the Gulf nations lose those facilities, they will look to the United States as maybe not being directly responsible, but they will be reevaluating their relationship with the United States. Each of these Gulf state nations will wonder, why did they invest? Why did they allow military bases? Why invest all the wealth in monetary values that they have? The tens of hundreds of billions, if not trillions, these Gulf state nations have invested. Why hold up their end of the bargain and keep their investments if the United States is not going to hold up their end of the deal? Their end of the deal is be the world's police, actually prevent Iran's missiles from, or drones from, destroying these facilities. And that's a massive order. But that is what is on the bill when you go forward and build military bases and you develop these relationships with these nations. It's quid pro quo. You get the military bases, so you have to provide the defense. If you don't provide the defense to the Gulf state nations, they're going to be pissed. They'll take their money and go fuck off to Russia or China or anywhere else they want to invest their money. So they'll keep their money in the US until they choose otherwise. And the black swan event is that they choose otherwise. How would we know that? It would require, first, a break below 564, 565 on the NASDAQ. You take the year of 2025, the open to the close. You take that 50%, that is a key algorithmic level, not psychological, algorithmically determined. The algorithms that are trading the NASDAQ that understand the midpoint, the 50% of the yearly open to close, those algorithms that are programmed to defend it will be buyers. If the algorithms see that price is aggressively beneath it, we may see acceleration beneath that point. This is not me predicting it, not at all. No, I'm not making a prediction. If there was a scenario where you break 565, 564, and suddenly you're at 560, and then you're at 550, that would be because the algorithms that were bullish above that midpoint of the 2025 open to close yearly candle, those bullish algorithms might have just shifted bearish and started to sell. So that could accelerate. That is what we would see if there was a mass exodus for the door out of the NASDAQ. I'm not making that claim. This is not financial advice that you should sell your investments. I've heard people talking about wanting to be risk off, and I'm not a financial advisor, but it's based on your risk aversion. How old are you? How close to retirement? The closer you are to retirement, the less risky your investment should be. You should have money market funds, debt, denominated instruments that are low risk, giving you a guaranteed risk-free rate of return. If you are very far from retirement, early 20s, mid-late 30s, you can be more risk on. And how much you passively invest, it depends on your discretionary income, all that stuff that a financial advisor would get into. I'm not a financial advisor. I'm not pretending to be one. So I'm not telling you to sell anything. The NASDAQ is still in an uptrend. The warning signs are there, but just because we see there's sell pressure on the weekly and monthly, that doesn't mean that suddenly it's a bear market. When we stop and go to year to date again, there's a very clear way to understand what are we down. Max year to date down 6.7%, almost 7%. We closed the day. Year to date, we're down 5%. That's a quarter of the way to a bear market. So there's a long way down, and the NASDAQ, until it actually breaks and holds below, I think the institutional moving averages is something I need to really show just quickly here and go to the weekly. So this right here is the 50 simple moving average on the weekly chart. And there we go. So you have the 50, the 100, and the 200. When you stop and look, you're in this massive uptrend, 2023, all the way up, 2024 to 2025. And the volatility has tested below the 100 weekly moving average, but a test below quickly broke back above. So there is unfilled gaps here. From the close to the open, that would be pretty insane to see that gap fill, hedging to the short side for a decline of 17%. That would be 17% lower. I'm not predicting that to happen, but a gap fill there testing below the 50 weekly simple moving average, the 100 weekly simple moving average around 532, 533, the 50 weekly simple moving average around 576, 577, the 200 weekly moving average, the 200 simple moving average on the weekly chart showing 437, 438. So still in an uptrend. Cannot argue this. We're getting close. The being beneath that 50 weekly simple moving average, that's the first red flag if we start to break and hold below that. I'm not aggressively bullish the NASDAQ here in the short term. In the short term, cautious. Cautious. There can be a bounce. There can totally be a bounce. But this uptrend, just as easily as the uptrend has been established, under the right circumstances, we can experience a very quick move to the downside. So it's best not to have a bias that, oh, we have to sell because of what's going on in the Middle East. President Trump is the world's greatest riverboat casino huckster that the planet has ever seen. If anyone can talk their way out of this situation, it's the orange man. So I'm not saying to put blind trust in him. Just don't be 100% convinced that he will only make this situation worse. At some point, he will capitulate because his constituents, the average Americans, at some point say, I cannot tolerate these gas prices, and they're reaching out and their voices are heard eventually. probably in a year. Anyway, the point I'm trying to make is don't be so blinded by your hatred or your love for Donald Trump that it convinces you the markets have to crater or they have to rally. The markets can be stuck sideways in consolidation for a period of months. This can happen, and if you are investing, it's a situation of stagflation, possibly. Not saying that will happen, but anything can happen. Wanted to see if I could make this smaller at all. I can make it smaller, okay. Bitcoin time, baby. Here, go year to date. We are just stuck year to date. There's not much to really get into for Bitcoin other than to acknowledge that I jinxed it. I was shifting to a bullish perspective on the short-term Bitcoin, thinking that this breakout here of we were 74, testing 75, imagining that the consolidation, if price could consolidate and hold above the 74, 75,000 area, if it holds there, shifting short-term bullish. Of course, we immediately then reject. Cue the curb your enthusiasm. I'm shifting bullish short-term if price can hold consolidation above 74, 75,000. Immediately it rejects. Immediately we go back down into the testing bear market territory. Year to date, down 19% for Bitcoin. Borderline bear market territory. When you're below 70,000, you're bear market. I started to think that the consolidation that we had been holding here had been sufficient for buyers to be more aggressive in the short term to try and test the 50%, try for 80,000. Could you try? No. They could not try. The buyers were insufficient to test above the high of 76,190. You couldn't get above 77,000. So this is natural volatility, I would say, for Bitcoin. An 11% move in the span of 5 trading days. 6, yep. It makes sense. I would say how price trades relative to the 50% of this candle. So 69,485, 69,485 is, price area. As long as you're holding above that, you're holding high or low structure still. So maybe you get some short-term bounce. I don't want to have a position on Bitcoin because if I give one, the opposite direction occurs. So I'll just keep my opinion to myself. My upstairs neighbor's puppy is starting to get rambunctious, so you may hear the foot clomping above. That is not me. So Bitcoin, again, I think showing the institutional moving averages here would be useful. So just give it more runway. You're just beneath the 50 simple moving average on the daily. I overlooked this when I was starting to shift to a possible short-term bias. I, in prior videos, had been explaining that below 80,000, I'm neutral. I should say above 80,000 neutral, below 80,000 bearish. That was the main point in prior videos. I was trying to be adaptive and adjust with how I thought the market was starting to move. So wanting to shift the bias in anticipation of that, which was overlooking the prior recordings, the prior videos that are still posted on Bitcoin, where the thesis is below 80,000 bearish, above 80,000 shifting bullish. When you clear the gap here, you're above 83,000. You need to be above 84, 85,000, going towards 90,000 for my short-term position to be bullish. I've talked ad nauseum on this channel about, as a store of value, Bitcoin is better than US dollar long-term, probably worth, my unprofessional opinion, not a financial advisor, but maybe 1 to 5% of a portfolio if you are deeming your risk appetite such. 1 to 5% of your portfolio invested in Bitcoin, a Bitcoin proxy. That is one approach to the markets in the long term. But in the short term, we're still beneath that 50 simple moving average. And some people will hate on technical analysis. They talk down, they put some disrespect on the simple moving average's name. They don't know what they're missing out on. That's fine with me. I know that the institutions don't use this on a chart, they use it tabular data. The algorithms run on it in a tabular manner. So I understand now more clearly that until this 50 simple moving average on the daily has price action break and hold consolidation above, until that happens, I'm just gonna hold my bearish, neutral bearish, short-term stance. MARA, been talked about on this channel. It may be destined to test $7 again. Might. It's a possibility. There's a probability. I am not giving financial advice. If there was somehow a scenario where it did test $7 because Bitcoin declined below 70,000, below 65,000, if Bitcoin declines and MARA starts to decline, MARA is simply a proxy to Bitcoin. You don't need to have a cryptocurrency account to have exposure to Bitcoin. You get a, hypothetically, based on the close here, if you test just below $7, it's a 21% decline in the stock's price. It's just to retest like this prior area. If you go down and retest this prior low, it's a decline of 24%. If you're hedging with puts, if I were hypothetically trading MARA, I would not be short shares. I would not be doing that. That has too much risk. With owning puts that would profit when price on the underlying MARA shares declines, with long-term expiration going closer to in the money than far out of the money, you wouldn't want to go with a $5 or a $3 strike. That would be insane. You'd target a $8, $9 strike, in my unprofessional opinion, not giving advice, but close to at the money, slightly in the money. If you deem your risk such that you want to have some of your portfolio hedging via the downside Bitcoin proxy MARA, you're breaking, trying to be above that 50 simple moving average, and then you're immediately back below it, closing above it, opening below it, closing. You're engaging with it here in a way that some traders would just discount it. They would say that's just circumstance, it's a coincidence. I believe that the way price action is oscillating this 50 simple moving average is happening by design, based on the algorithms that are trading this underlying MARA and how those algorithms use the institutional moving averages, 50, 100, 200 simple moving averages on the daily, on the weekly charts. They're tabular forms. As long as you're above the 50, 100, 200, you're in a bull trend. And here on MARA, you're in a quite obvious bear trend. QQQ, come back here real quick. You can just see, you're starting to see a test and holding below the 200 simple moving average on the daily chart. That's not that good. That's not that good. I should have played with the light more earlier because I just realized how bad it is. Who cares? I'm hideous, thank you. Now, with QQQ on the daily, being beneath the 200 simple moving average, beneath the 50 and the 100, there's a cross of the 50 simple moving average breaking beneath the 100 simple moving average. I don't know if there's an actual name. Bearish crossover. They call it a death cross. The other way is some bullish golden cross bullshit name. Here we're calling it a death cross. When you see the 50 daily cross below the 200 SMA, the 50-100 crossover serves a similar purpose, indicating intermediate term downward momentum. Intermediate term downward momentum. Sounds about right. We have been in an uptrend and we have not tested the simple moving average, that 200 simple moving average. The last time we tested it was really back here. Excuse me. It was back here in March of 2025. You broke below them all. Let's just have a, based on the past, how far did we fall from that? So I think it's really more so here. So it's this trading day, you close beneath it for the first time, holding closes beneath it, you have a decline lower of 18%. Okay. So an 18% decline in 22, 23 trading bars, followed by then a break higher. I'm sorry about that. My throat is really scratchy all of a sudden. I'll keep this short. Last time the NASDAQ ETF QQQ broke below the 200 simple moving average on the daily, the market, you broke it, you looped, held the rejection. You had cleared beneath the 200 simple moving average. You're stuck beneath it. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. The 12th trading day tries to break. You can't hold a test, a close above that, nothing. The next day you gap, close lower, and you have continuation lower until an 18% decline from this close here down. You see you're down 18.5%. So if we saw a similar situation unfold, we would be seeing we're already down 5% on the year. If you see a further decline of 17, 18, 19%, you're entering bear market territory. So maybe there's a probability of this. Start to open that possibility up and be open to the larger term hedge to the downside with longer dated NASDAQ hedges. I'm not giving that financial advice to anyone. I'm not a registered financial advisor, but just I'm thinking out loud for my own portfolio, possibly hedging to the downside if we see that continued consolidation beneath the 200 simple moving average on the daily. If you're not seeing any positive geopolitical news, if you're not seeing any real price action. I mean, right now the NASDAQ is declining as I speak. Let me just check this. I need to change equities to show the extended. Should just get rid of that. So the NASDAQ has declined. I mean, closing 588, currently 584.6, 0.7. Its volatility, sellers dominating the volume in this after hours. I guess it's technically the Japanese, the Asian market session now. So sellers are just dominating it. And you can just see, based on how we had closed, stuck lower high versus the highs of day, you see then the pre-market lower high here versus lower highs leading to lower lows. Pretty simple. So I mainly wanted to talk about the NASDAQ, the fact that I've been unquestionably bullish, and now it's time to question. Now it's time to really stop and determine, are we holding this uptrend in the short term, or is the short term presenting more downside volatility? I've talked before on this channel about the, where's my seasonality analysis? It'll take me forever to find it now. Seasonality across the 4 major U.S. equity indices ETF. Seasonality across the 4 major U.S. equity index ETFs. You can see when we go down the QQQ, based on the average range percent, the high minus the low divided by the open of every single trading day, classifying them based on if the month is in the spring months or is this day within the summer, fall, winter months. During the 2-year time frame, the 6-year time frame, 10-year time frame, 25-year time frame. The spring is higher across all time frames, full stop. There is more volatility in the spring than any other season. This is the QQQ. You have IWM, spring months, greater volume across all time frames. Fall here, the largest, it should even out over the largest time frame here. You can see 1.82, 1.69, 1.84, 1.72. Very different compared to the high of 1.88, the low of 1.53. That's a percent difference, where the percent difference between the winter months compared to the spring months. You know, your winter months on average have 8%, almost 10% less volume in IWM in the winter months. So DIA here, spring months, you can see they are having seasonality effects across all 4 the major U.S. stock market indice ETFs, index ETFs. Same with the SPY. So seasonality is real. We're starting to see the volatility unfold. The entire point of the QQQ before the bell, episode 1 here, was a report to prepare anyone interested in trading the NASDAQ in understanding, based on the prior day's range, where might the buyers and sellers battle it out, what price points may be magnets where we see price gravitate to, where fair value consolidates and spends time deciding where it wants to trend based on how that structure consolidates. Today, the structure, again, lower highs, lower lows on the daily. When we look back on the 10-minute time frame here, this is again showing you lower lows, holding lower highs, the pre-market now selling into lower lows because it held lower highs relative to the lower high, relative to the high of day for Monday, March 23rd, 2026. If you enjoy this kind of content, remember to like, comment, subscribe. It helps with the algorithm. The last thing I wanted to review, again, was the S&P 500 index, because the channel's been documenting that longer than the NASDAQ, understanding the current scenario. Go back further. The 2025 scenario is really just me taking this range here, just the high to the low. This was originally 2025's all-time high down to its low. This is the start of 2025. You have the high, you make a slight new high, looping and tagging before you decline. This decline here, the full range on the S&P 500 index, down 21% at the most in the peak trade war volatility in 2025. From this range, the algorithms are plotting it and trading it accordingly. We have broken to the previously communicated Fibonacci extension upside target 69.58, 69.60. We've held very little consolidation above. There was no continued strong open closes holding above this key level. The algorithms were failing to maintain a dominant bullish sentiment because of their inability to consolidate and have aggressive buyers continue to push price higher. The market shifted after its inability to consolidate above this price point here. We've been shifting towards a more bearish sentiment, a more corrective phase. From the high here to the low here, you can see S&P 500 index down 7.5%. When you look at the 2026 high to the low. So I just wanted to reiterate that the S&P 500 index is a great passive income, passive investment, I should say, for a majority of Americans, especially the boomer class that have been investing since the 70s and the 80s and the 90s through the 2000s and the 2010s. The boomers have done phenomenal. Give yourselves a round of applause. To the millennials and the Gen Zers, do you want to invest and buy a index ETF that is 7-8% below its all-time highs? Are those valuations still elevated? You be the judge. You take the 2025 low, you go up to the 2026 high. If it'll lock on, thank you. It didn't even lock on. Oh my goodness. That's got to be close enough. So I think it's just important to see how price has previously been engaging in this area. How the S&P 500 cash index trades relative to 64.90. I believe that 23.6% of that range from the low of 2025 to the high of 2026, seeing how there's left of price action here as well. I believe that this being at one point a all-time high that we had been testing, consolidating along before we made new all-time highs, this may be a point where we start to see sentiment shift. Sentiment in the short term has been bullish. I don't know what's wrong with me. It's been bearish. It's been bearish. The sentiment has been bearish. I can't talk. Ever since we have made this all-time high, failing to break higher, all-time high, one failed to make new all-time highs, a second failed to make new all-time highs, You're making lower highs here. So it's lower highs leading to lower lows in the short term, year to date. You look at more of 2025's data, you're still in an uptrend. It's just that the uptrend is starting to test the prior higher low points. How price trades relative to this area will determine if we are holding the higher lows relative to 2025's lows and we can continue to break higher. Otherwise, you have risk of continuing to decline to where prices had prior consolidation points, maybe getting stuck between the 6,500 down to the 6,350, 6,400 area. That's if you break and hold below 6,490. It's all different scenarios. There are probabilities of this event occurring. That a probability is not guaranteed. It is probably a low probability event. Unless the black swan events unfold, I would think that the short-term sentiment has been bearish. And in the short term, if buyers are defending 6,500 on the cash index, you may see a bounce. If the cash index, the S&P, if you are seeing it start to follow the NASDAQ, where you close 655, you're currently 652 and 20 cents. This is, you're going to possibly have the cash index open below those key price points, and then the intraday volatility, how it shakes out, where we close, will then provide more insight into, are the buyers starting to step in and defend the key higher low points in the uptrend that would defend higher lows versus 2025's lows, or are we starting to fail and test beneath those points? If we're failing and testing beneath those points, shifting towards a short-term bearish position and hedging appropriately could provide profitable opportunities. It could provide asymmetric returns depending on what expiration and at what timing these contracts are taken, and having the proper risk management. I'm not providing financial advice. I'm not telling you to hedge your portfolio to the upside. I'm not telling you to hedge your portfolio to the downside. I'm not telling you to sell or buy anything. This is not financial advice. Please do not clip this and make any other claims. I am just trying to provide an analysis of the before the bell. This is the first ever QQQ After the Bell, episode 1, a recap of the Before the Bell, episode 1. And it is a mix. It is a sign that the report, while I want it to be simple, concise for the average day reader to be open-minded to reading it and possibly understanding how the S&P 500 will trade after reading it, I think as much as I wanted to keep it simple, there's an oversimplification of just bull, bear, consolidation scenarios. There was a mix where the first half of the day was the bull scenario, the second half of the day was stuck consolidation beneath the, within the prior day's range. Closing below Friday's high, right? So moving forward, if you think in the comment section down below, you can voice your opinions. Should the updated QQQ Before the Bell have a more in-depth analysis of the various scenarios, trying to explain how price needs to hold the higher low consolidation, breaking and holding with sufficient time to then test the upside targets that were mentioned, the 598 area. If you like this kind of content, if you think there could be any improvements, alterations, feel free to leave a comment down below. Like all of that, it helps with the algorithms across all the social media platforms. On Substack, Beta Heuristics, on YouTube, Beta Heuristics, Instagram, Beta Heuristics, and X Beta Heuristics. Feel free to like, comment, subscribe, and let me know your thoughts about Bitcoin, the NASDAQ, S&P 500, and everything, equity and crypto markets in between. Until the next recording, stay green.